Here's a comprehensive tutorial on stocks and bonds, detailing what they are, how they work, and how a beginner can start investing in each. Let's start with stocks. So, what are stocks? Stocks represent ownership in a company. When you buy a share, you own a small piece of that company. Stocks can provide returns through price appreciation and dividends, which are payments made to shareholders. Now, let's talk about the types of stocks. Common stocks. These give voting rights and potential dividends. Preferred stocks. Generally, these don't have voting rights but offer fixed dividends and priority over common stock in case of liquidation. Investing in stocks offers several advantages. Potential for high returns. Historically, stocks have provided higher returns compared to other asset classes, such as bonds or cash. For example, from 1970 to 2023, $100 invested in gold grew to $5,545 compared to $22,419 for stocks. Liquidity. Stocks are generally easy to buy and sell on stock exchanges, providing investors with the flexibility to enter or exit positions quickly. Ownership. Buying stocks means owning a piece of the company, which can provide a sense of connection to the business and participation in its growth. Dividends. Many companies pay dividends to shareholders, providing a source of income in addition to potential capital gains. Diversification. Investing in a variety of stocks can help spread risk. By diversifying across different sectors or geographical regions, investors can reduce the impact of poor performance in any single investment. We'll touch on this concept more in future videos on ETFs and mutual funds. Inflation. Hedge stocks have the potential to outpace inflation over time, helping preserve purchasing power. Over the past 30 years, the S&P 500 had an after-inflation gain of 840%, while inflation reduced the value of a dollar by 50% over that same period. Tax advantages. In many jurisdictions, long-term capital gains and qualified dividends may be taxed at lower rates than ordinary income, providing a tax-efficient way to grow wealth. Access to information. Stock markets are regulated, and companies must provide regular disclosures about their performance, giving investors access to information that can inform their investment decisions. Growth opportunities. Investing in stocks can provide exposure to innovative and high-growth companies, particularly in emerging industries like technology and healthcare. Influence on corporate governance. As a shareholder, you may have voting rights on certain corporate matters, giving you a voice in company decisions. There are 3 steps to investing in stocks. First step, educate yourself. Some basic terms to know are bull market, bear market, market cap, and the P/E ratio. A bull market is a period of time when stock prices and other asset prices rise over a sustained period. There is usually a positive investor outlook and a strong economy during this time. A bear market is the exact opposite, during which there is a prolonged period of declining stock prices, often with a drop of 20% or more in major stock indexes from recent highs. Market capitalization, or market cap, is the total value of a company's outstanding shares, calculated by multiplying the share price by the number of shares. The P/E ratio measures a company's current share price relative to its earnings per share. A lower P/E ratio is generally better. An average P/E ratio range is 20 to 25. Anything below this could be considered a bargain, whereas anything above this might be considered overpriced. Also, follow market news and trends. Step 2. Choose a brokerage account. Open an account with a brokerage firm such as Charles Schwab, E-Trade, or Robinhood. Consider commission fees, ease of use, and research tools. Then, research companies. Analyze company performance, industry trends, and economic factors. Use resources like Yahoo Finance, Google Finance, and company websites. And step 3. Make your first purchase. Start with a small amount of money. Decide how many shares to buy based on your research and budget. Finally, monitor your investments. Keep track of your stocks and make adjustments as needed. Consider setting stop-loss orders to manage risks. A stop-loss order is a tool that investors use to limit potential losses on an investment. Here's how it works. You set a specific price at which you want to sell a stock if its price drops. This is known as the stop price. If the stock reaches or falls below that stop price, the stop-loss order automatically converts into a market order, selling the stock at the next available price. Simple example of stock price appreciation. To pull all the pieces together, here's a simple example for a fictional stock that illustrates how price appreciation works and how it can lead to significant gains for investors. For your initial investment, you buy 100 shares of Star Innovations Incorporated, or SII, at $20 per share for a total investment of 100 shares times $20 per share to give you $2,000. After holding it for 1 year, the company releases a groundbreaking new product that receives rave reviews, leading to increased sales and positive market sentiment. Due to this positive news, the new share or stock price has risen to $35 per share. Now, let's do a simple calculation to determine the price appreciation of the stock. You started with an initial price of $20 per share, but now the new price is $35 per share. To calculate the price appreciation, simply subtract the old price of $20 per share from the new price of $35 per share to get $15 per share. So, the stock value has appreciated by $15 per share. Here's what this means to you as a new investor. Based on your original total investment of $2,000 for 100 shares, we can calculate the new value of your total investment by multiplying 100 shares by the new stock price of $35 per share to equal $3,500. So the value of your total investment has grown from $2,000 for 100 shares to $3,500 for those same 100 shares. So to recap, your investment in this fictional stock has appreciated in value by 75% over the year, which yielded a profit to you of $1,500 due to the increase in stock price. This illustrates the power of stock appreciation for long-term wealth generation. What are bonds? Bonds are debt securities issued by governments or corporations to raise capital. When you buy a bond, you are essentially lending money to the issuer in exchange for interest payments and the return of the bond's face value at maturity. Types of bonds. Government bonds, which are issued by national governments, like U.S. Treasury bonds. Municipal bonds, issued by states or local governments, and these are often tax-exempt. And then we have corporate bonds, which are issued by companies to raise capital. Advantages of investing in bonds include regular income, as bonds typically pay fixed interest at regular intervals. They also come with lower risk, being generally less volatile than stocks, and, of course, portfolio diversification, which helps reduce overall portfolio risk. How to invest in bonds in 3 steps. First step, learn the basics. Understand key terms like face value, maturity, and credit worthiness. The face value of a bond, also known as par value or principal, is the amount that the bond issuer agrees to pay the bondholder at maturity. It is typically stated on the bond certificate and is used to calculate interest payments. Here are some key points about face value. Interest payments. The interest or coupon rate. Payments are calculated as a percentage of the face value. For example, if a bond has a face value of $1,000 and an interest rate, also known as coupon rate, of 5%, the bondholder would receive $50 annually. Repayment at maturity. At the bond's maturity date, the issuer must repay the face value to the bondholder, regardless of the bond's market price at that time. Market price versus face value. Bonds can trade at prices above, premium, or below, discount, their face value in the secondary market, depending on interest rates, creditworthiness, and market conditions. Bond creditworthiness refers to the likelihood that a bond issuer will be able to make the required interest payments and repay the principal amount at maturity. It is crucial for investors because it helps assess the risk associated with investing in a bond. Here's how it works. Credit ratings. Independent agencies like Moody's, S&P, and Fitch assign credit ratings to bond issuers based on their financial health. Ratings range from AAA, highly secure, to D, in default. A higher rating typically means lower risk and lower yields, while lower ratings indicate higher risk and potentially higher yields. Factors affecting creditworthiness: financial health. This includes the issuer's revenue, expenses, profits, and cash flow. Strong financial performance generally indicates better creditworthiness. Debt levels. High levels of existing debt compared to revenue can signal increased risk. Broader economic factors, such as interest rates, inflation, and economic growth, along with other factors such as industry risk, investor sentiment, market conditions, and default risk, can all impact an issuer's ability to pay. Understanding bond creditworthiness is essential for making informed investment decisions, as it directly affects both the risk and return of bond investments. Next, familiarize yourself with how interest rates affect bond prices. Typically, when interest rates rise, bond prices fall. Then step 2. Choose a brokerage. Open a brokerage account that offers bond trading, such as Vanguard or Fidelity. Research bonds by analyzing different types of bonds based on issuer, yield, duration, and credit rating. Resources like FINRA's Market Data Center can be helpful. Step 3. Purchase bonds by deciding whether to buy individual bonds or bond funds. For individual bonds, look for auctions or secondary market listings. Finally, monitor interest rates. Keep an eye on interest rate trends, as rising rates can decrease the value of existing bonds. Adjust your holdings if necessary. Here's a simple example to illustrate how bond price appreciation can lead to profits for investors. For this example, the fictional Star Bonds Corporation decides to issue bonds to raise money. Their bond has an initial purchase price or face value of $1,000 and an annual coupon rate of 5%. This means that the bond will pay you $50 in interest each year. To calculate that, you multiply $1,000 by 5%. The bond has a maturity of 10 years, so you pay $1,000 to purchase the bond. After 3 years, the market interest rates drop to 3%. As a result, existing bonds with higher coupon rates become more attractive. Therefore, the market value of your bond, with its 5% coupon rate, now increases. Let's say that the market price increases to $1,200 due to the higher demand. You now decide to sell your bond for $1,200. You have just made a profit of $200, which is calculated by subtracting your purchase price of $1,000 from your selling price of $1,200. But not only that, you also received $50 in annual coupon payments each year for the 3 years you held the bond. Therefore, you received $150 in total coupon payments over the 3 years. This puts your total profit from this bond at $200 from the sale plus the $150 total coupon payments received, for a total of $350. Not bad. To recap, investing in stocks and bonds can be a rewarding way to build wealth. Start with education and research. Use a reliable brokerage platform. Diversify your investments to manage risk. Keep learning and adjusting your strategy over time. Always consider your financial situation and consult with a financial advisor if needed. Happy investing! Future videos will explore topics such as ETFs, REITs, and cryptocurrency. For more tutorials on investing for beginners, please click subscribe.